This is a special session designed for plan advisors, specifically to talk about this new plan model, the small employer HRA. My name is Jason Cogdell. I'm a benefits attorney for Pro Benefits, and I'm joined by Josh McGee, one of our benefit consultants.
Good morning, everyone. We appreciate your time, and we really hope this is informative for some of these new topics that we're going to be discussing today.
Our goal today is to, number one, educate you on the new small employer HRA model. Some things you may already know, some things you may not know, but we want to educate you on the model and specifically who can use it, how they can use it, what the plans look like, what some of the pros are, what some of the cons are. So that's what we'll go through today, as well as the options that Pro Benefits has to assist advisors and specifically employers, small employers that may elect to do QSE HRAs. As a word of context, these new HRAs, even though they are unique and new for 2017, are health reimbursement arrangements. So Pro Benefits has been in the business of health reimbursement arrangements since those plans were first allowed by IRS rules in 2002. So we reimburse hundreds of HRAs. Most of them, to no surprise, are deductible reimbursement plans and co-insurance reimbursement plans tied to group health plans. There are many other unique designs, bucket of money HRAs that use, for example, the card with them. There are dental reimbursement plans and vision reimbursement plans. All of those HRAs are still in place. This is one new model that is unique to small employers and is the only model that can reimburse individual health premiums. This new model, the Qualified Small Employer HRA, or QSE HRA, not only do we get a new acronym, but this is one of our longer ones, so everybody's thrilled about that. This was part of a larger law, the 21st Century Cures Act, that was passed by Congress in December, signed by President Obama. This is not part of the ACA. In fact, the QSE HRA is an exception to the ACA, to the extent that the ACA in 2014 changed existing law because, as you may know, employers dating all the way back to 1961 under an old revenue ruling that is still in force today under the IRS code, employers have been able to reimburse individual health premiums tax-free to employees. And that was the case until 2014 when the Affordable Care Act changed the law. And basically what the Affordable Care Act said is that an employer cannot pay or reimburse non-taxable or taxable individual health coverage because the employer cannot rely on the individual health coverage to meet the ACA market reform requirements, including no annual or lifetime limits, et cetera, et cetera. So employers were always able to reimburse individual health insurance coverage, either directly or through an HRA, and HRA just happened to be the best way to do it for compliance reasons. And then the law changed in 2014. Now employers of any size cannot do it. But there was limited transition relief for small employers that was for 2014 in the first 6 months of 2015. There's confusion in the marketplace that small employers had transition relief beyond June of 2015, but they did not. And so since July 1st of 2015, no employer was able to pay or reimburse individual health premiums without violating the ACA. So that's just a brief word of context. Now, with this new model that's part of the 21st Century Cures Act, again, not part of the ACA, so it's not going to change if the ACA is repealed or if this new AHCA, American Healthcare Act, is passed by Congress in 2017. This model will still apply. What we see as listed in the bottom bullet points on this slide, again, big picture here, there's no change for employers that have over 50 full-time employees. Those employers cannot use a QSE HRA. They cannot reimburse individual health premiums without violating the Affordable Care Act now, while the ACA is still the law of the land. And if any employer has a group health insurance plan, it can't use a QSE HRA. So this new option only exists for employers that A, are not applicable large employers under the ACA. So that means during the prior calendar year, the employer had fewer than 50 full-time employees plus full-time equivalents in the prior calendar year. So not an ALE, not subject to player pay and reporting. And also, and it can't be a ALE by common ownership. So it has to be truly a small employer, fewer than 50 full-time employees plus full-time equivalent. So that's part one, got to be a small employer. Part two, the employer cannot sponsor a group health insurance plan. This is only intended by Congress to be an option for small employers that do not have, either cannot afford or elect not to have a group health insurance plan due to cost or whatever other reasons. So the employers that can use this model fit in a very defined small category. Now, on that second point, if you've done some reading about QSE HRAs, law firm summaries or compliance summaries put out by employer or advisor associations, you may have read that the rule is even more broad, that the employer cannot sponsor QSE HRA if the employer not only sponsors a group health insurance plan, but also a group dental or vision plan or supplemental health plan might disqualify the employer. I don't think that's correct. The way that I read the statute, it would apply only to a group health insurance plan, and a group could still have group dental or vision or supplemental health and have a QSE HRA. But the statute did not resolve it so clearly that there's no doubt. So this would be one of 2 or 3 issues that I think will get clarification on from the IRS going forward in 2017 or soon. So my understanding, my personal view is that an employer who does not sponsor a group health insurance plan but does sponsor a group vision plan, for example, can have a QSE HRA. I understand there's some people who have taken a more conservative stance, but just want to let you know about that. In my view, whether or not the employer has a major medical group health insurance plan is the key qualifier or disqualifier in addition to size. So that's the who, now the when. The QSE HRA was part of the law passed in December and is effective beginning in 2017. So employers can use this model now. Employers could have started January 1st. Some did, not many. Employers can also adopt this plan design anytime during 2017 or beyond. So the employer could choose to adopt it, for example, middle of the year, a group that doesn't have group health insurance, doesn't have a benefit. Maybe they're just giving cash to the employees to go do what they'd like with health insurance. By the way, that's still going to be an attractive option for some of these very small groups that just don't want to be involved in insurance or benefits. If a group does implement a plan mid-year, the maximums are prorated because the maximums are calculated on a calendar year basis. So the plan doesn't necessarily have to be calendar year, although I think they will all end up being calendar year plans for several reasons. Number one, the maximum is calculated on a hard calendar year cap. So if you have a short plan year, a plan that starts, for example, October 1st, you've got the prorated, you can only use 1/4 of the annual maximums, and we'll get to those in a moment. Second, the maximums are indexed, and the indexing will change for each calendar year. And so that's another reason why using it on the calendar year basis makes sense, as well as the fact that individual plans and marketplace plans are on a calendar year basis. So the rates for those plans will change. So for all of those reasons, I think all of these plans will ultimately be on a calendar year basis, although the statute doesn't explicitly require that. So the when is now. Now the what. What can the plan do? Again, big picture perspective, these are HRAs, so they act like HRAs in nearly every scenario. One rule for HRAs, and it's adopted by the QSE HRA statute, is that HRAs may not be directly or indirectly funded by an employee. So what an employer cannot do, for example, is set up the QSE HRA to fund out-of-pocket medical, dental, and vision expenses and individual health premiums. Fund it to the max and then take a deduction from the employee pre or post-tax to pay for the QSE HRA coverage. That you can't do that. HRAs have to be funded by the employer, not the employee. That's the kind of the bedrock principle of HRAs is employer-funded health or medical reimbursement arrangements. So it has to be employer-funded, number one. Number two, there is flexibility of design in terms of what is actually reimbursed. So just like full regular HRAs that employers sponsor, larger employers and employers that have group health plans, the HRA could reimburse anything allowed by Section 213D of the IRS code. That means out-of-pocket medical, dental, or vision expenses. So no change there. That's just a regular HRA rule. By the way, if the ACA is repealed, or more specifically, if this new law, the AHCA, is passed to supersede portions of the ACA, over-the-counter medications would come back in as pre-tax items. That would be a significant out-of-pocket medical expense. That would be an eligible expense for these HRAs as well as other HRAs and FSAs and HSAs. But for every purpose, what can be reimbursed by this QSE HRA is the same as regular HRAs, with one example. This is the only HRA or the only plan in general that can reimburse individual health premiums. So this would be the only way that an employer could fund on a tax-free basis individual health premiums. Now, the next question is, can a QSE HRA reimburse just individual health premiums, or does it have to reimburse all out-of-pocket medical, dental, and vision expenses? The statute is written in a way to suggest that these plans will reimburse all out-of-pocket medical, dental, and vision expenses from employees. But there's not an explicit exclusion that says you can't limit it to individual health premiums. So some of the employers we've talked to have been interested in just reimbursing individual health premiums. Other employers, when they hear about the options, are perfectly fine to just allow any out-of-pocket medical, dental, and vision expenses. But the employer does have some flexibility of plan design, and I think that's another point where we'll see some clarification as we go. Otherwise, standard HRA rules apply. There's claim and reimbursement. A flex card is available to be used with the plan, although this works best when it's for out-of-pocket expenses. There's going to need to be some manual process for insurance premiums, since that's not a expense that's automatically adjudicated by the card process. For us, that's a MasterCard Flex card. And importantly, expenses are only eligible for reimbursement after they're incurred. So this plan cannot, for example, pay an employee the full annual amount in January for medical premiums that won't be paid through the year. It's a monthly type of reimbursement process. You have to have the coverage has to become effective before you can be reimbursed for the expense. So the standard HRA rules will apply, other than some of the specific, eligibility and maximum changes. Now, speaking of the maximums, here are the maximums. And this is unique because HRAs by themselves do not have any monthly or annual maximums, but the QSE HRA does have maximums. These are the 2017 maximums, which will be indexed per year. The maximums are based on what individuals, employee or employee and spouse and family, can be reimbursed from the plan. So if the plan allows only for reimbursement of coverage held by the employee and only for expenses incurred by the employee, the annual maximum for 2017 is $4,950, and that's $412 per month. The maximum for family coverage, if the QSE HRA can reimburse expenses incurred by not only the employee but spouse and or dependents, whether premiums or out-of-pocket expenses, the annual maximum is $10,000, $833 per month. And again, these maximums are calculated on an annual basis, much like the HSA maximums. And so they will be indexed on the calendar year, and any partial year plans, as I mentioned a moment ago, would have to be prorated, because you couldn't, for example, implement the plan October 1st and reimburse an employee for up to $10,000 of family coverage. That would not be allowed. How will it be checked? One of the compliance requirements is that the amount of the value of the coverage has to be included on the Form W-2, one of the sub boxes in box 10 of the W-2. It's not taxable, but it has to be listed as a reporting item to the IRS. So they'll know, if employers report, how much in reimbursement the employee received. It theoretically could be scrutinized and checked by the IRS if they chose to do so. So that is a brief run through of the plan design basics. Before I get into the compliance, Josh, you want to say a word about what we are hearing from advisors who are interested in the plans, and specifically what they're interested in?
Yeah, absolutely, Jason. Thank you very much. So some of the conversations that we've had with brokers is kind of what is this plan? with the, the high cost of premiums, that employers want to help out with this, but again, they're at the size that are 50 or under where they're not required to do a group health plan. So, we're trying to figure out with the passing of the new law, like what is the basics that we can do for employers, what parameters we can kind of set up and really offer solutions. So a lot of the questions have been, do you do full administration on this? Would you do compliance-only services? So those are some of the things that we have, and we've been listening to brokers, and we've figured out a few solutions that we'd like to propose.
Josh, would you say it's a fair statement that what we've seen to date is a lot of research and exploration by advisors or employers versus actual setting up of the plans?
That's correct, yeah. So a lot of trying to figure out exactly what's the best options with people from the research that they've done. And we're here to hopefully answer a lot of those questions or kind to dissolve some of those assumptions that we've been seeing from brokers that have been asking questions, and also the employers that have been presenting these obstacles more than anything.
Yeah, thanks, Josh. One interesting point by word of context, I mentioned at the top that this is kind of back to the future to the extent that employers could reimburse health premiums to 2014. Again, we administer more than 500 HRAs. We've seen pretty much everything in the HRA world. What we experienced before 2014 in the ACA change is that very few employers had an HRA that did not have a group health plan. Very few. Those that did sponsored basically a bucket of money, out-of-pocket HRA. Not many had just the HRA for reimbursement of individual health premiums. That model has traditionally been unique to the very small employer market. I mean, 5 employees, 4 employees, 3 employees, nonprofits, and churches. As an example, is something my church did until I had to advise them not to do it when the law changed in 2014. So before the law changed, very few employers did this, and the employers that reimbursed individual premiums were, for the most part, very small employers and nonprofits. So I think we can use that as a basis and context as we look ahead to see how many employers will use it now. Will a lot? No. Will it be an effective tool and option for some small employers for various reasons? Yes. So maybe it's the small employer that can't afford a group plan because of the current community rating under 50 and it's an older population. That may be an example of one group that this may benefit. Now, we understand that our advisors, our partners like you all on the session today, just like us, our number one goal, our number one priority is the group health insurance market. That our business is referred to us by virtue of brokers. The group health insurance market has made our business what it is by virtue of being able to pair our tax benefit plans and our compliance services with the group health insurance market. So we're not going all in on the QSE HRA to the extent of we don't think it's the best thing ever. We think it is one more option for small employers that some employers are going to want to do, so we need to do it right, and that's part of the reason for the session today. But we are not expecting an avalanche of these plans. I know that some people feel differently. Some people think this is the next big thing for small groups. We'll see. I think there are pros and cons, and you all can figure out some of those for yourselves. But some brokers, to build on Josh's point, some brokers are coming to us and saying, I really need this for some small employers. Help me figure out how to do it. Some brokers are coming to us and saying, I'm going to need to sell against this in the under 50 market. What do I need to know to sell against it? So hopefully some of this information will help on both points. Back to the plan design basics. One additional point. Question, can an employer elect a smaller maximum rather than using the annual maximum allowed by the law? And that is correct. The employer does not have to fund these plans to the max. The employer could choose a lower amount. For example, in the discussions we have, I would say a fair guess as to an average monthly reimbursement that employers consider is $300 a month, $3,600 a year. That's probably an average. Some want to do more, some want to do less. I haven't heard one less than $100 a month. I've only heard a few that wanted to fund the max. So an average is probably $300 a month, $3,600 for the year, but the employer does not have to fund the maximum if they choose to sponsor the QSE HRA. Another question, can small business owners participate? So you all are probably familiar with the fact that there are no pre-tax benefits for, as an example, S-Corp owners, more than 2%, or LLC members or partners in a partnership. The IRS, since those are pass-through tax entities, does not allow owners of those entities or members in the LLC context to have tax-free benefits. And the same is true for the QSE HRA. So the QSE HRA can be used, it can be funded, but if it funds any coverage for an S-Corp owner, LLC member, or partner in a partnership, that coverage could be paid tax-free at the time, but it's going to be ultimately added to the taxable income, the K-1 income of those owners. So this is not a workaround to provide tax-free coverage for small business owners, even though that's been a popular topic. Keep your questions coming. Happy to address those during and after the session. Before we get into some practical aspects of the options we offer to help employers and the subsidy impact, which I know has been a source of confusion, I want to say just a brief word about the compliance items around the QSE HRA. Good news, the QSE HRA is specifically exempt from ERISA and COBRA. So the law specifically says these plans are not, quote, group health plans for purposes of ERISA and COBRA. So that's good news for small employers. These plans are not subject to general ACA requirements like the PCOR fee as other HRA plans are, and ACA reporting would not be required for a QSE HRA. So all that's good news. What doesn't apply? It's a fairly simple plan in terms of compliance, but there are some items. The first and foremost of which, this is an IRS tax benefit plan, so we have to follow IRS rules regarding plan documents and summary plan descriptions. We don't have to follow the ERISA rules because it's not an ERISA plan, but it is an IRS tax benefit plan, so there needs to be a plan document, a summary plan description in place. That's something that we do for our HRA clients and all of our other benefit plan clients, and that's something we'll do for QSE HRAs. The second big compliance requirement is a required notice. The employer is required 60 days before the plan start or the plan renewal to provide a formal written notice to eligible employees that they will be in the plan, that the plan could impact their subsidy eligibility at the health insurance marketplace, and I'll come back to that in a moment, and provide other specifics regarding what the plan is and what it is not. For example, not subject to COBRA continuation coverage, not subject to all ACA market reform rules. So the notice requirement is kind of the new requirement, something that makes the QSE HRA unique, because that requirement does not apply to other HRAs. It doesn't apply to FSAs or health savings account bank accounts. Now, the IRS issued a notice last week or 10 days ago suspending temporarily the notice requirement for 2017, in part because they realized that these plans are brand new. Some employers are going to want to use them now rather than wait 60 days. So what they did is they basically suspended the requirement that the notices have to be provided in advance. And then they also said that the IRS will be providing further guidance on the notice and possibly a template. So we have a template now, just a very basic form of what the notice should be, but I think they're going to provide a formal template that employers can use as a model going forward. But the notice requirement, which will apply and will be a big deal for these plans, is currently suspended. The only other significant requirement, and there are some insignificant ones, the only other significant requirement is that, as I mentioned before, the amount of the coverage, or specifically the value of the coverage, is going to be reported as an informational item in box 10 of the Form W-2 for anyone that was a participant during a particular tax year. I mentioned a couple of things that we'll get more information on, including the notice and including the question of whether group dental or vision insurance could affect the QSE HRA. There are 2 or 3 or 4 questions that we could use clarity on, and we'll get more guidance from the IRS as we go. But I wanted to say a brief word about the compliance requirement. So as Josh alluded to, and he'll cover further in a moment, one of the options we have for employers, just like our HRA administration, is full administration. We handle the claims and reimbursement and the compliance items and everything else. And then one of the options is just these compliance items as listed on the slide. Now, a common question for QSE HRAs has been, if the employer wants the employees in this small group to go out to the marketplace and get a subsidy. Whether this group does that now, just sends everybody to the individual market, or whether they're interested in doing that, if the employer offers a QSE HRA, would that negate the ability of the employee at the individual level to go get a subsidy? The answer is it's not a black and white yes or no. Having a QSE HRA does not disqualify the individual from getting a subsidy. The question is, with the QSE HRA reimbursement in place, if you count that as part of the cost and you look at what the cost of the marketplace coverage would be, that second lowest cost of silver coverage at the marketplace for the individual or the family, if you look at that total cost out of pocket, factor in the QSE HRA, would the cost of that coverage be affordable or unaffordable to the employee and family based on the ACA affordability rule, which is currently 9.69%? If the cost of the coverage minus the QSE HRA is less than 9.69%, then that means the coverage is affordable, no subsidy. If the cost of the marketplace coverage minus the monthly QSE HRA benefit is greater than 9.69%, then the marketplace coverage is unaffordable, the employee and family remain subsidy eligible. Is that confusing? Yes. Is it too complicated? Yes, but that's where we are. Now, practically, and I'll share an example here, practically, in all the examples I have run personally, the individual or the family remain subsidy eligible. So what I thought when I first read the law in December is that, well, it's all well and good that technically someone would remain subsidy eligible, but I think the QSEA, unless it were only $100 a month, is going to disqualify the employee from the subsidy. However, the marketplace premiums are the average marketplace premiums are so expensive in 2017 that basically everyone will remain eligible for the subsidy. And then effectively what will happen is the subsidy will just be reduced by the amount of the QSE HRA. Here's one example. We've got a 50-year-old individual employee that wishes to cover spouse independence at the marketplace. The employer is willing to fund up to $400 a month of the coverage for the family, $4,800 per year. Now this family has an annual household income of $60,000. To illustrate how expensive the marketplace coverage is, and no surprise to you all who are advisors on the call, and I'm pulling this data, by the way, from the Kaiser Family Foundation Marketplace Calculator, which uses average annual national numbers. $1,366 would be the monthly cost of coverage for the second lowest silver plan. Again, so the employer is willing to pay $400. The cost of the coverage is $1,366. So what is the net cost of coverage? If we just take the monthly cost of coverage, $1,366, reduce it by the QSE HRA number, the net cost would be $966 a month. Is that affordable to the employee based on household income? In this case, no. $966 is 19.3% of household income. So that means not only is the family still eligible for the QSE HRA, but they're going to get, not only eligible for the subsidy, but they're going to get the full amount of the subsidy only minus the QSE HRA amount, which in this case, the subsidy would be $963. That would be the federal subsidy paid to the carrier for the cost of the monthly family premium. And the net subsidy, because they're in a QSE HRA, will be $963 minus $400 for a $563 net subsidy. So effectively what we've got here is the federal government's going to pay part of the premium, the employer is going to pay part of the premium, and then the employee family is going to pay the net premium. So all of this is more complicated than it probably needs to be, with the ultimate answer being, I think basically no matter what QSE HRA benefit is provided, unless the employer were to fully fund family coverage at $10,000 a year, basically everyone is still going to be eligible for a subsidy. And also I think this affects what the employer may do. As an example, it would be hard to get the employer too motivated to pay $400 a month if all that $400 a month is really doing is replacing money that the federal government would have paid anyway. So I think this creates some mixed motivations, but this is where we are. In the interest of time, I'm not going to go through this example, but the next example, and we'll share a copy of the slides, 40-year-old employee, single coverage, making $45,000 a year. and the employer was fully funding the individual QSE HRA at $413 a month, and still that premium was unaffordable, 11.9%, and this individual still eligible for the full subsidy, even though the net subsidy would be very little because it would be the regular subsidy minus the fully funded QSE HRA. So good deal for the federal government in that example. But you can use other examples, but this is the formula that would be used to determine the impact on subsidies. Again, with the moral of the story being that everyone is still going to be eligible for a subsidy. It's just a matter of how much. Question, if an employer decides not to reimburse individual medical premiums and just out-of-pocket medical, dental, and vision premiums, would that still impact the subsidy? Would the QSE HRA still be taken into account? I think the answer to that is yes, technically, although clearly the law was written that QSE HRA would only impact the subsidy if it was reimbursing that marketplace coverage, but I don't know that the law was written to take into account that particular scenario. So that's a great question. I think that may be something else we get further clarification on. So I'm looking at it that any QSE HRA benefit could impact the subsidy, not just reimbursement of premiums, but I don't know that for sure, and the law does not specifically answer that question. Now, that's a word about subsidies. That's a word about compliance and plan designs. I want to bring Josh back in for a moment to address the options that we are making available to assist advisors and employers who may be interested in further exploring the model.
Thanks, Jason. So what we at Pro Benefits are, from hearing the questions that have been brought up, we're offering two solutions to employers. So first of all, we are going to be offering our full administration. So we will do all claims and reimbursements. The employee will be responsible for sending in those premium invoices for reimbursement based upon the plan design that we have contracted with the employer with. We'll also participate and also do any employer support. You'll have a specific admin for your setup that we'll be helping with, what's being paid out each week for the HRA, also substantiating to make sure everything is correct, and we also keep the balances for you on that. Also, the full administration, you'll be having all the compliance items, the plan documents, and making sure everything is in compliant with the IRS. If it's something that you don't want to do the full administration on, we are offering just a compliance-only support service. With that compliance-only support service, we will do all the legal documents for you, get everything set up for you that you would do in the that need to be compliance with the IRS. We'll also do assistance with employee notifications and reporting requirements, such things as we will assist you with W-2 reporting as well, and then also any other anything else that is required by the IRS. And then also on the other compliance-only support service is you have full-fledged access to our Jason and our other compliance director, Chris, on any questions that you would have during this time, and we'd be happy to answer those questions to make sure that there's anything that needed assistance during the plan year. So those are the two solutions that Pro Benefits is offering. If you are interested in any of these solutions, feel free to reach out to any of our benefits consultants or myself. You can email us at sales, S-A-L-E-S, at probenefits.com, and we'll be happy to go over some detailed things that will help you to serve your clients that are interested in this QSE HRA.
Yeah, one thing to add to that, a lot of employers and advisors think of the decision whether to outsource administration or not based on claims. And if you've got a small employer, not a lot of people, monthly reimbursements, it seems at first glance, well, it's no big deal. They can just handle the reimbursements as part of payroll, and without having to outsource that, and they can just handle the record keeping internally. And that is right. Employers who have the appetite to do that can do it. However, keeping in mind that these are small employers that don't have a benefits or payroll staff, so it's going to fall to someone at the company to do it, just like your regular benefits administration and contact for other insurance purposes. Number one, do they have the capacity to do it? Number two, are they okay with the HIPAA responsibilities? Because keep in mind, if an employer is self-administering, this would be true for any benefit, not just QSE HRAs, and this is an issue we deal with a lot in full HRA administration. One of the reasons that small employers who are interested in self-administration turn it over to Pro Benefits to administer regular HRAs is that they don't want to have the HIPAA data. They don't want to be on the hook for that. They don't want to have the formal privacy and security policies to protect the HIPAA protected health information. But HIPAA is a factor here. We can't deny that. So if an employer is going to do it themselves, so to speak, whether or not they're going to use our compliance only service, which by the way does not include HIPAA support, all the HIPAA obligations are on the employer. There's nothing we can do if they're handling the PHI internally. You know, that's just a conversation you're going to want to have, because unless an employer is already comfortable with self-administration of a health benefit that includes HIPAA protected information, you know, that is something that needs to be addressed. So our goal with the compliance support is to help advisors and employers who just need the compliance piece, the legal docs, the notice, the W-2 reporting advice. We're going to help them, and that's inexpensive to do. We're willing to do that, but I will also want to be candid that, you know, what compliance means is the compliance steps required by the plan, not, you know, the day-to-day HIPAA and internal record keeping, which is a value of administration and frankly is a reason why our HRA administration is an effective tool. Going through the questions now, if you have, I think we've covered most of the questions submitted in the question box. If you have additional questions, Josh and I are going to hang around for a few more minutes to answer those. If you do not have a question, we will allow you to go now. So thanks for joining us today. And again, as Josh said, feel free to reach out to our team for any additional information on QSE, HRAs, or any of our other services. So on behalf of Josh and myself and the entire Pro Benefits team, thanks and enjoy March Madness.